Hello everyone, Steve Lentz here with Discover Options. Welcome to the Prepared Mind. This will be for Friday, July 22nd, getting ready for Monday, July 25th, 2016. Presented material is for educational purposes only and should not be construed as personalized financial advice. Welcome everyone. We have two reports we'd like to share with you today. These are for advanced traders, particularly those that like to trade premium collection strategies, condors, butterflies, range trading type strategies. This would be the S&P 500 Condor Butterfly Timing Report and also the Directional Likelihood Report for the same market. We would love for you to subscribe to us. Just click on the button below and you can subscribe, and then you'll be alerted whenever we prepare one of these new reports. Also, you should know that this is the video version of something that Frank Fahey kicks out every week called the Prepared Mind. It is the text version is located at the Discover Options blog site. Just go to discoveroptions.com, click on the blog link, and that'll take you to just a wonderful blog entry he has giving you detailed information on volatility, great earnings information, just a great analysis of the broad market from a professional options trader. Also, before we get to the reports, I'd like you to click on the link in the above right. We could get you a free ebook if you'd like, co-authored by myself and Jim Graham, Simple Steps to Options Trading Success. On to the reports. We have two of these available for you today. This is the first one would be the Condor and Butterfly Timing Report. And what we're going to do is go through the reason why we do this, the methodology, and then I'll give you the actual current condition and the edge level that we have for timing of the condors and butters. Why would you want to look at a report like this? Well, here's just an example. Back on December 31st, the market had begun to trade in a range, but due to the analysis we have and the technology that I've created, we were able to ascertain that at that particular time on December 31st, there really was a negative edge to selling premium via condors and butterflies with range trading. In fact, a minus 4.2 edge existed at the time, which really meant that there was a higher than usual likelihood that the market from that point would be more volatile than what was being implied by the option prices. Now, that's not a good scenario if you are a range trading premium seller with condors and butters. And look what happened. Indeed, the market plummeted in that particular case. Now, that's just one example, of course, but I think you get the gist as to why we would want to take a look at this kind of thing. So here's the current market condition from Friday the 22nd. Thursday was a down day, a downswing day, lower high and lower low. Friday was an upswing day with the close being higher than on Thursday. We're above the 50-day moving average. The 15-3 stochastic is very high, between 65 and 99, kind of pushing up over 90 actually. And the stochastic is actually below its 3-period moving average. So this is a very unique market condition. And the question being here at this point, is this a good condition for selling premium through range trading strategies, condors and butters? That's the question on the table. So what I'd like to do is go over the methodology now before we get into the actual results. So what do we do to determine this? Well, first we have to observe how much the market actually moves from a given close. I'm going to call that actual volatility. Next, we observe what the market move was predicted at the time by option prices. We call that implied volatility, the implied volatility of the time premium in those options. We then compare the two, and we will label that particular bar and all bars as either being favorable for premium selling or unfavorable for premium selling, all right, using range trading strategies. So here's a look at the methodology for looking at the actual move, looking at a market's actual move. So what we'll do is we'll take a particular close at 2076. We go forward 21 days, and we're going to observe how far the market moved the maximum amount either up or down. In this case, it went down 50 points at one point at the low of that particular day in mid-May. And it turns out that that 50 points was about 2.4% of the market, that it dropped there. And you can see I created a little indicator down here for the actual move. So so here's the question now. What was the market move being implied by the option prices at that time? Back there on what, April 28th or so. Okay, and when you dial up the VIX and you look, and this is the SPX, as you dial up the VIX and take a look, the VIX was implying a move of about 4.4%. Okay, so what that means is that the VIX was implying a move greater than what actually came about. And we would consider that a favorable environment to have sold, in hindsight, to have sold premium through condors and butterflies. And what I like to do is to go back in time and label those bars, blue for favorable, red for unfavorable. All right, so what we're going to do now is take a look at the percentage of bars that were favorable and unfavorable. And then we're going to take a look at the bars that match our current market condition and see what the percentage of those were favorable and unfavorable. And if there's a big difference, well, there might be a trading edge possibility here. And when you go back in time and you go back 4,100 bars, and you look at it, it works out to be roughly 2/3, 1/3, roughly a little bit less than 2/3 of all the bars in the SPX going back turned out to have been favorable for selling premium neutrally. A little bit more than 1/3 were unfavorable for selling premium through condors, butters, range trading type strategies. So that's the benchmark statistics. Now, when we look at our current condition now, and we go back to Jan of 2000, 4,100 bars or so, how many do you think match our current condition that we have here as of Friday's close that I went over? I'll tell you, 97. 97 times the market matched the same condition we have as of Friday's close. Now, of those 97, what percentage of those were favorable and unfavorable? And as it turns out, of those 97, roughly 75% were favorable, 25%, or a quarter of them, were unfavorable. Now, what does that mean? Well, when we compare it to the 2/3, 1/3, we could see that there's an edge. Of the 97 matching our current condition, a greater percentage of those are favorable. Were favorable for selling premium neutrally. A lower percentage were unfavorable. So in this context, we would say that we have a positive edge of 10.3%. That's 75% minus the baseline of 64.7. Bottom line here, folks, is that there is a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. So if you're a premium seller using condor butterfly type strategies, you're operating in an environment where it's better than a coin toss that it will be favorable for selling premium neutrally. Now, you still have that 1 in 4 chance that the waters can get a little rough, okay, but you have a better than usual chance. You have three chances out of 4 that it will be okay, that you could have smoother sailing there. So thumbs up in that particular context looking at history. All right, now we could go to the other report, but before we do, I want to point out that at discoveroptions.com, we have a wonderful set of mentoring programs beginning at just $99 for beginners, going up through the advanced folks that want to get into premium selling, adjustments, all that stuff using our equity track education, 14 mentoring sessions, one-on-one with a professional options trader in the equity track and the futures track as well for those of you trading futures options. Also, if you trade earnings, we have a great little course with Frank Fahey. We'll give you the options view module for earnings, and you'll get some sessions with Frank as to how to trade earnings announcements using option view. All right, so take a look at that. Give us a call. We'd love to piece together a good package for where you're at. Let's take a look at the directional likelihood report now. And here's our current market condition, as I just expressed. And here's the question on the table. Since Jan of 2000, how often has this same condition occurred? And what direction did the market go? We're in an overbought situation. We had a downswing day, then an upswing. All right, we're in an overbought situation with a stochastic above 90, clearly above 90. If we went back and looked at the past, at those 97, well, what direction did the market go? Did it typically go up, down, or kind of chop around in the middle somewhere? And that's what we're going to try and figure out, is the likelihood of it going up, down, or chopping around. Here's our methodology. We first want to understand the historical distribution of price. Okay, I'm not looking at implied volatility now, right? Not yet in this context. I just want to get a broad historical distribution of price from every close. Then I'm going to go to the market condition we have and look at the distribution of price after those, each of those 97. Okay, if the two are different, well, then we might be able to ascertain a trading edge. So how do we determine just a broad historical distribution of price? Well, what I use is I use one standard deviation volatility band set from each bar's close. Okay, I use 3 sets of bands, 5 days into the future, 10 and 15. I'm using 20 period historical volatility, and these are log normally distributed. So here's just an example of 10-day bands set one standard deviation from the close. You have a band set up here going out 10 days, band set down here going out 10 days. Come on. Where's my thing? There it is. And the question is for this particular close, did the market go up and hit the upper, go down and hit the lower band, or wobble in the middle? And in this particular case, Shazam, it went up and hit the upper band. And so we record for that particular close the fact that it hit the upper band. Now, what about the band over here, the one on the right? We have the upper band, 1 standard deviation away, going out 10 days. 10 trading days. We have the lower band, and the question here is did the market go up and hit the upper, go down and hit the lower, or wobble in the middle? Let's take a look. What did it do? Wobbled around. It tried to hit the lower band, if you look carefully, but it did not. So for that particular close, it hit neither band. And so what we're going to do then is for every close, we will record how often price struck the upper and the lower 5, 10, and 15-day bands, and we'll ascertain a historical distribution of price then. And in this case, coming up from Jan of 2000 through July 22nd, just this last Friday, you could see here it hit that price struck the upper band 29.7% of the time. The upper 10-day band, roughly 23%. Upper 15-day band, roughly 23% of the time. The lower 5-day band, almost 30%. The lower 10-day, almost 30%. Lower 15, 32%. So that gives you a good baseline as to the distribution of prices in a combination of bullish and bearish markets going back to Jan of 2000. Over 4,100 closes altogether that we're taking a peek at. Now, next, what do we do next? We have to understand the distribution after the specific market condition develops. Each of those 97 times the market attained the same condition we're in now. We're going to go back and look at those 97 and see what the market did. Okay, and so what we do is we look at each of those 97 in the context from the close, like on Friday. We'll look at the next day and see what the distribution was if price goes above the high on Friday. Or what if on Monday it goes below the low of Friday? What was the distribution of each of those 97? All right, and so let's take a look. Here it is. As of the close, let me show you what happened. This is very interesting. Okay, up here we have the baseline historical distribution, and then here we can see in this case that of those 97 signals from the close, measured from the close, it hit the upper 5-day band just 11.3% of the time. Okay, that's an 18% difference from a 29.7 to 11.3. Okay, that's a big change. It did not hit the upper bands that often. Look at this. It hit the upper 10-day band just 12% of the time. 10.9% difference. It hit the upper 15-day band just 18.6% of the time instead of 23. A difference there, a negative difference. Then we go to the lower bands, and we can see that it did not hit the lower bands as often, although the differences are much less. The differences are much less. Clearly, it hit the upper bands really far less often than it did on the baseline. Okay? All in all, what this is painting a picture of is lower volatility, lower market volatility. It's hitting the upper bands less often and the lower bands less often. The upper bands, it's hitting less often to a greater measure of a difference there. So if you were to lean one way, bullish or bearish, it's failing to hit these upper bands in greater measure. So you would lean this a little bearish if you had to make a choice, make a choice. But all in all, you're looking at a picture of lower market volatility going on here. Okay, now what if it went below the low, or excuse me, what if it went above the high? What if on Monday price exceeds the high on Friday? What do we have there? Well, of the 67 times that it exceeded the previous high, it hit the upper 5-day band way less. Look at only 3% of the time instead of 30. All right, so that's a picture of it being overbought and going up higher and failing to continue all the way up. So we could see here, upper 10, look at these huge differences on the upper bands. On the lower bands, it hits those less often as well, even greater measure than at the close. So again, if it goes above the high of Friday, you're looking at an even greater likelihood of lower market volatility. Finally, let's go to the situation where if price exceeds the low, if it exceeds Friday's low, well, now it's hitting the upper bands a little bit more often, and in 2 of the 3 cases. So we're looking at a picture here, and then on one of the lower bands, it hits slightly more often. If it goes below Friday's low, you're looking at a likelihood of increased market volatility, but just a slight chance for higher market volatility. Not much though, but just a slight. And again, there's no directional bias here. If we would be bullish or bearish if perhaps there were positive differences in all 3 of the bands, either up or lower, and you just don't have that case here where it's hitting one set of bands more often. So that's what the picture is here. Now what I like to do also is instead of just using a 20-day volatility number to determine the bands, I like to also use a skew-adjusted VIX number. A skew-adjusted VIX number to determine the bands, meaning that the upper bands are going to take the VIX and we're going to shave a little bit off of that for the upside volatility, because if you know anything about options on the SPX, you know that those calls, as you go out of the money, they have lower implied volatilities than the out-of-the-money puts. And the SIBO publishes a skew number that I use to kind of back into an upside VIX and a downside VIX. The upside VIX determines the upper bands. Okay, the downside VIX determines the volatility for the lower bands. Now, because the VIX is generally higher than statistical volatility, the bands are going to generally be farther away, and hence they will be struck less often. So the baseline historical distribution, instead of being, say, 23 to 32%, here you can see we have them being roughly 14 to 21%, something like that. They're getting hit less often. But some consider these to be more accurate bands because we're letting the option prices dictate their width, and they're asymmetrical as well. We see the same picture though at the close. All 6 bands are getting struck less often. If the high is exceeded, 5 of the 6 bands are getting struck less often. And if the low gets exceeded from Friday, well, then you have a mixed picture again. 2 of the 6 are getting struck slightly more often. So slightly more of a likelihood for higher volatility if it goes below Friday's low. Here are the skew adjusted numbers. Statistical volatility is only at 10%. The upside VIX is at 10.3. The downside VIX I have at 13.7 as of Friday's close. Okie dokie. Now, let's take that 13.7. Let's talk about a possible strategy now, okay? Let's go take a peek at a hedged bull put spread idea if you're at all bullish. All right, or you're thinking the market's not going to move very much, like what historically has been indicated here. Here's an idea that we like because you don't have to really sweat the upside. And how many condor and butterfly folks are there out there that when the market's bullish, it can really go on a tear to the upside and cause some great consternation. So as of Friday's close, the VIX was at around 12. The upside VIX, or excuse me, the downside VIX, I have it at 13.7. The upside VIX is at just 10.3. So let's take that 13.7 now. Keep that in mind, and we're going to go to option view. We're going to plug it in up here into the little volatility box that determines the standard deviation levels. We're coming out to the August 27th expiration, 34 days. And what we do is a hedged bull put spread. We do a bear put spread right at the money. Then we come out a full standard deviation to the first strike outside of it, and we do a 20-point spread 5 times, enough to create, at least a 4 or 5% yield if the market goes up. All right, and that's what we have here. And when you analyze this, what's nice is that you'll see that no matter how far the market goes up here, we're going to make 5% on our money if it goes to expiration. If the market goes down, well, the hedge starts kicking in and lifting the T+ line upward. All right, and so if you then, you're dealing with the market going down and giving you some headache, if you let it go to expiration, it's going to give you more than 3 times what it would give you if it went up. So in that sense, you're making the market pay a little bit for your headache. But if you let it go all the way to the short strike, well, it looks like a little bit more, about a 1.5 times what you're trying to make here at expiration if it does go down. What's nice here too is that when you go and look at the the price chart, and we use our little profit and loss button on here, we can see that this trade will make money if it goes up or if it goes down, and we're giving it a lot of room for error if it does go down, keeping in mind around here you're making that 17%. Up here, you're making that 5%. So that's a pretty decent picture. All right. Hope this has been helpful for those of you advanced traders looking at butters, condors, and just liking to get a beat on the SPX in general. I'm Steve Lentz with Discover Options. We'll be back next week. Hope this has been helpful. Take care. Have a great week trading. Bye-bye.